Good evening, everyone. This is Swaminathan. Hope everyone's had a good summer. I was personally myself out for quite a bit of time, so this is a video I'm making after a very long time. Just wanted to say hello to everyone, and I thought I would make this detailed video today because obviously the markets are in definitely a turmoil. Today is August 24th. It was Monday. Now, last Friday we saw a big 3% drop, and today we are seeing another 4% drop in the S&P. Now, this morning we started out, and this is definitely some sort of a flash crash. Went down all the way. At one point, the S&P was down almost 130 points, and then came back up again, recovered about 70 points, went back down 40 points, and then recovered another 60 points, went back down 20 points, and as you can see, it was just mayhem altogether. On the Dow, if you look at the Dow, that was a total up and down of almost 3,000 to 3,500 points today. So obviously, there's a lot of things going on in the market, and you can see the VIX has climbed up to 41, and we haven't seen these levels. In fact, this morning at one point the VIX was close to 50, and when this down move was happening. So this is obviously a very, very troubled time in the markets, and a lot of it is coming from China. Now, China, if you've looked at the Chinese markets, and what we'll do is we'll take a look at some longer term charts because that's really what gives us some perspective. So if you look at a 1 year daily chart, and this is of course the S&P, but what we want to do is look at the FXI because that's the main China ETF. And as you can see here, yeah, and even before this there was it came down to 36, went up to 52, and now it's back down to 32. So quite a big damage in the Chinese markets now. So the general consensus is this is something to do with the Chinese markets and not the Chinese economy. Personally, I don't believe that. First of all, China's numbers can never be trusted, the official numbers that come out. However, if they say it's a 7% GDP growth in China, I can, at least my personal opinion is that I would discount it altogether. So maybe their economy is growing at maybe 1%, maybe 2%. That's about it. Now, the numbers that are officially coming out of China itself are very scary, and these are the official numbers. So my sense is that it is going to start impacting the economy. And if you look at the Chinese economy, even over the last 10 years, and if you just go do a Google search on these things in China, they've had these what you call ghost cities. So if you look at ghost cities of China, and I mean, in fact, that's the first thing that comes up on Google. And even the ghost cities of China, and if you look at just the images for these ghost cities, it's absolutely crazy. And I don't know what happened here. Images. All right, there we go. I mean, these are the cities that they've built, and there's really nobody occupying. So these are all the government and the state government and the what do you call the state-owned organizations have banks have lent out all these loans to build these cities, but there's really no takers here at all. And as you can see there, it said that there are 64 million empty apartments in China. I mean, so a lot of this money has gone to waste, and so at some point, you're going to have to pay a price for this. Although they say it's not going to hit the economy, depends on how much pain comes out of China now, and I feel it will affect the economy, and at some point the Chinese government is already losing control of the markets, and at some point it will filter into the economy. Now you can see the S&P futures are up about 25 points, but I wouldn't trust this at all because even in previous downturns, what we've seen is you're going to see some big rallies, and then then it gets taken down again. So a good example would be if you look at the the S&P itself. And if you go back, obviously you can go back to the crisis time and all of that, but let's just go back to 2011, because we know that in 2011, let's go back 5 years and let's do a weekly chart. And in 2011, we had this big crash right here in July and August of 2011. So here, at the top around 1358, and at the bottom around 1058. So that's a 300 point loss on the S&P. And if you look at these individual days, you'll see that there are plenty of rallies, there are plenty of down days, up days. So you're going to see a mix of everything. So just because the futures are up tomorrow doesn't mean that everything is okay. We really have to be careful at this point, because certainly if you drew a trend line, say for example from here, and if you drew a trend line, that trend line is broken today. It's broken by a lot, and so you don't want to, you want to be careful during this time. Especially the VIX has climbed up to 40, and so if you have already have positions, many people already have positions and they were not able to get out of it, or then you want to hedge it, and you want to hedge it with SPY puts, or you want to maybe beta weight it. Now all of these concepts I've covered in other videos, but if you are looking to trade this is going to be a very what to say, hands-on kind of trading, because you're going to have to be active. As you can see today itself, we had such violent moves up and down, and so you got to think about what are the kinds of trades that will work here. So let's go to the analyze tab. Let's look at the S&P. Generally like to take the I trade the S&P quite a lot, but if you look at the S&P at the money options, you can see the bid ask spread is very wide, and just even for these options that are expiring in 4 days, you have a 63% volatility, and just the one standard deviation move is 106 above or below. So quite a bit of volatility. You can see the option prices. The at the money option is like between 35 and almost $50 here on the 1890. That is just incredible option prices. And a day like today is actually quite rare. You're not going to see a whole lot of days like this. Now we may not see violent days like this, but you can bet that there is going to be volatility in the markets, and so up and down movements are going to happen. And so I want to sort of give give an idea of what kind of trades you might want to take. So you might think, okay, if there's a rally, I'll buy some call options, but that would be the biggest mistake you can make, because as you can see, the volatility is so high that you're going to pay extremely high prices, and we all know what happens when the market goes up. The volatility is going to come down, and so even if the stock moved 20, 30, $40, you might not see a profit at all. So you don't want to do calls. What you can do is a couple of things. So for example, let's just take the S&P as an example. If today the market is at 1890, 1893. And so if you, even in an option series that's expiring in 4 days, if you go, you can see the option prices are really pumped up. And so let's say we go up to 80 strikes, and here we can go up to 1695, 1700. Maybe that is, even there you can see there's like $10 or $11 in option prices. And also let's just go back even further. Let's go to 120, and you can see that 1600 is still a $5 option right here. So now here you can see the bid ask spread is 80 cents, which is the normal S&P bid ask spread. So if you're going to take a position, you want to take a position somewhere here. So if you did a bull put here at the 1600, and we're talking only 4 days for this series though, yes, and here we are at 1890, and the 1600 is at a 5 delta, and it's still going for about $5. So if you see over here 1600, let's say we did a $10 spread, and you get 30 cents. That may not sound like a lot, but you're going out so far. This is at 1600. And similarly, if you come to the call side and you go at least 200 points out, and you'll see that you can maybe get a decent premium somewhere here. Let's say 2020, sell a vertical, and you can pick up another. Let's do that also as a $10 spread. So you can pick up 70 cents. So that's about 7% return in about 4 days. And if you look at it from a condor aspect, then what we see is this is what we have. The market is right here, and we are a good over 280 points, 1600, yeah, so 1893. The market is here, I'm sorry. So we have quite a bit of room on the downside, and this is a 7% return trade. You want to be very safe with these trades, and you want to try to just make 5 to 6% this week. We have only 4 trading days left. I mean, so you really want to think of trades that really are way out of the money, and you can do that because the VIX is so high and there is still a lot of option premium when you go further out. But you don't want to buy calls. You can buy puts at if the markets are tanking again tomorrow, then you can buy a put, but you'll still be paying a lot of money. However, if the market is going down, then the VIX is going to increase, and therefore buying a put may make more sense than buying a call. Buying a call is definitely not advisable in this market environment. So let's go also take a look at a couple of stocks. So say for example, we are looking at Apple, and I've got some stuff here. Let me take that off. So if you look at the Apple options, and you'll see that once again, Apple, the volatility is 79%. That is just incredible. For there's no earnings, there's nothing. So and for 4 days, that's just incredible volatility right here. So if you Apple is at 103, so even if you wanted to go out 10 points out at 93 and 113, you can probably put in an iron condor there. Now, the other thing you need to watch out for is the bid-ask spread. So, you saw on the SPX, the bid-ask spread of at-the-money options are almost $4. And, that's a problem. And even here, you can see it's almost 20 cents on the at-the-money option on a series that's expiring in 4 days. Now, if you were to look at regular Apple options, the bid-ask is going to be 1 cent. Apple bid-ask spreads are the tightest in the market of any stock, and usually it's 1 cent, maximum 2 cents, but here it's almost like 18 cents. And that's a problem because as a percentage of the price of this option, if you're paying 18 cents on a $2.70, that's about 7.5% you're paying on the bid ask spread itself, and therefore that's the hurdle that you have to cross. And so whatever return you make has to be anything above 7.5%, because that's what you're giving up on the bid ask spread. So you want to keep that in mind. In volatile times, market makers are going to increase the spread, and so you want to be very careful that you're not overpaying for this for any option. And in this case, we will be overpaying. So basically you want to, if it's best if you stay out of the market at this time, or if you want to get in, you want to get in with these very specific trades that have a very, very low probability, go far deep, far out of the money, and sell some premium, because obviously with the VIX at 40 and all the stocks volatility has just been jacked up, and so the ideal thing would be to sell some premium at very, very safe levels. So anyway, so that's the video for today. Once again, below this video you'll see a link for a webinar. Sign up for the webinar. That's this Sunday. Markets are definitely in turmoil, and we're going to see this volatility for quite some time, I believe, unless the Chinese government is able to somehow put a lid on this crisis that's coming out of China. It's highly unlikely. They've been trying all kinds of stunts to control the markets. And first of all, controlling the markets is never a really good idea. But and the Chinese government has been trying a lot of tricks, a lot of various tactics, and none of them are working. So it's unlikely that this thing is going to be contained in the near term. Regardless, I mean, something, anything could happen. If the government does come out with a bazooka, like say, for example, a $500 billion QE, just like we did in the US, unless the government comes out with some big, huge announcement, I think this crisis is going to deepen. In the meanwhile, we're going to see up days, we're going to see down days, and even within a particular day, you're going to see quite a bit of volatility. So, best to stay out. If you're going to take trades, take very safe trades that are way out of the money. Selling premium would be the way to go because of the high VIX. And if you want to buy long options, then put side is definitely better than the call side. And obviously, you want to buy puts only if only if you see that the markets and or the stocks are tanking. And at that point, buying puts would not be such a bad idea. All right, folks, great to be back and look forward to seeing you on the webinar. And we'll speak to you soon. Thanks. Bye bye.